ETF Insights is brought to you by Nikko Asset Management. Your goals, our commitment. Welcome to ETF Insights. I'm Michelle Martin. Today I have my sights on bond ETFs. Why, you ask? Well, you're going to find out in a minute. First, let me welcome Eugene Lim, Senior ETF Business Development Manager from Nikko Asset Management Asia Limited. Eugene, thanks for joining us again.
Thank you so much for having me again.
Always great to speak with you. So demand or interest for T-bills has been really strong recently. Would you consider bond ETFs a good complement to T-bills?
Yeah, I think absolutely, and I absolutely agree with you. Interest and investor demand for T-bills really not showing signs of slowing down yet. I was just looking at the stats earlier. I think applications for the 6-month T-bill reached a record high of slightly over 16 billion in the 9th of May auction this year. And generally speaking, the yield on the T-bill does remain elevated. And all that in the backdrop, investors have also regained confidence that the US Federal Reserve may cut interest rate this year. So, in that context, I think that's why we're seeing so much demand and interest for T bills. Someone said, is this potentially a once in a generation kind of opportunity? I would say yes. When I look at data stretching back about 20 years, the yields that we are seeing right now, well, it's definitely been the highest I've ever seen it in my career, in
Wow.
my lifetime. So I would say yes, with some confidence. It is in terms of locking in the use. It is a once in a generation kind of opportunity right now.
Okay, so take us
Yeah,
through the primer for what a bond ETF is, Eugene.
yeah. You mentioned that yes, it is a complementary investment instrument, and really the ETF allows investors to gain exposure to a diversified portfolio. In this context of today's call, I'm going to talk about a diversified portfolio of relatively safer investment grade bonds, and then there's some potential for capital appreciation should interest rates start to fall. So, in a nutshell, bond ETFs gives you exposure once again to a diversified basket of bonds in a single trade. So, in the same way that a stock ETF may allow you the ability to own many stocks in one trade, similar for a bond ETF. Exactly the same thing. Diversify your bond holdings in a simple way. I think it's not a surprise then, with more interest growing in bonds, in T bills, and now in bond ETFs, there is a growing popularity among Singapore investors. So I was just looking at SGX stats. Total fund size of bond ETFs listed on SGX reached 4.6 billion as of December last year. And that's a very, very sizable number. In terms of what products there are, what ETFs there are, if you're looking for bond ETFs, which offers exposure to Singapore bonds or Singapore dollar denominated bonds, we do have two bond ETFs listed on the XGX. They are currently also the two with the largest assets under management as of June this year, right? They are Nikko AM's ABF Singapore Bond Index Fund and the Nikko AM Singapore dollar denominated investment grade corporate bond ETF.
Both of which we're going to get into in a bit. Do you think we've sufficiently
Yes.
covered how bond ETFs compare to T-bills? Anything to add there, Eugene?
Mm, I could add a bit more, but maybe I'll just try to summarize it into three main points.
Okay.
So I think as investors, everyone looks at you. T bills at the moment, the 6 month T bill cut off as of the most recent auction on 18th July was 3.65% per annum. We do note that use of T bills varies according to how much issuance amongst other factors. But well, the most recent T bill auction 3.65%. The ABF Singapore Bond Index Fund. That one, with the average yield to maturity of the entire basket, is slightly lower at 3.2%. The investment grade corporate bond ETF gives you a slightly higher yield, comparable to where the T bill is right now, of about 3.66% as of June this year. So, in terms of yields, sort of still within the same ballpark, right? Because we're looking at essentially safe investment grade bonds. But in terms of duration, I think this is where we get a lot of questions about sensitivity to interest rates.
Yes.
So T bills, because of the really relatively short term or durations of the instruments, it's generally only like 6 months to 12 months. Whereas for the bond ETFs, it's a much longer duration. And when we look at duration as a measure of sensitivity to interest rates movements, we look at weighted average duration in years as a measure. 7.76 for the ABF. So that's quite long duration, quite sensitive to interest rate movements, and slightly lower the investment grade corporate bond ETF of about 5.6 years. Right.
Mm.
So this is just where, when it comes to duration, the bond ETFs do offer you a longer duration type of instrument.
Very important
La-
point there. I remember you
Very
raised
important.
duration as well that in the last episode. Yeah.
Yes. And I think the last one, it's about the potential for capital appreciation.
Mm.
Okay, so this is where people, let's say you are aware of T-bills, you are aware that the bond ETFs gives you, well, a basket of diversified bonds in one trade. I think the next logical question is, which one gives me a greater potential for capital appreciation? Well, for T-bills, it's generally very safe, right? And because it's a single instrument, it's a single bond. And how it works is that you receive principal amount at maturity, whether it's 6 months or 1 year from now. There is potential for capital appreciation if interest rate falls, but not so much. Whereas for the bond ETFs, because once again duration is a lot longer, there is greater potential for capital appreciation if and when interest rates start to fall.
Important as we
Yeah,
anticipate a landscape where interest rates decline. And we know there's an inverse relationship between interest rates and the prices of bonds.
sure.
Eugene, help us understand what is the ABF Singapore Bond Index Fund?
Very good question. The ABF Singapore Bond Index Fund, well, is the first Singapore dollar denominated Singapore government bond ETF that
Mhm.
was launched back in 2005. So it's had a long history, and it tracks an index. And this index is also the similarly named IBOX, ABF Singapore Bond Index. So what goes into this index? It comprises of Singapore dollar bonds issued by, namely, the Singapore government
Mm.
or Singapore government linked entities. This would include entities that I'm sure every Singaporean quite familiar with: HDB, Housing Development Board, Temasek, and the Land Transport Authority. The index may, at some points of time, also include Singapore dollar bonds issued by other very well rated investment grade Asian governments or entities linked to these governments from time to time. One name that I can give as an example is the Export Import Bank of Korea. Right. So in other words, by holding on to the Singapore Bond Index Fund as an ETF, you get exposure to this basket of securities that currently is made up of mainly Singapore government bonds. 80% Singapore government bonds, lion's share Singapore government bonds, HDB 12%, LTA about 5, and Temasek roughly the remaining 2%.
Diversify your investment portfolio with the Nikko AM Singapore Bond ETFs. Learn more at nikkoam.com.sg/ETF. Eugene Lim is Senior ETF Business Development Manager at Nikko Asset Management Asia Limited. This is ETF Insights. I'm Michelle Martin. We're revisiting these bonds. We've done previous episodes on them, but we thought now would be a great time since bond ETFs are in such demand. Help us understand what the Nikko AM SGD Investment Grade Corporate Bond ETF is all about, Eugene.
Right. So the Nikko AM Sing Dollar investment grade corporate bond ETF offers investors access to Singapore dollar denominated corporate bonds with a relatively low risk of default. We do repeat in the name investment grade corporate bonds. I think this is important
Mm-hmm.
because this means that these are issues with, once again, a relatively low risk of default, which is rather important in this day and age, right? Because as an asset class that you want to add into your holistic portfolio, this serves as a good way to manage portfolio risk as a whole, right? And so, what are some of the bond issuance inside this ETF? Singapore blue chip companies are really the main bulk of this, right? Highly rated bonds issued by banks like DBS, UOB, OCBC, foreign companies as well, with similar investment rate
Any
ratings.
examples of the foreign companies?
Yeah, AIA Group,
Mm,
ABN AMRO,
okay.
Commerce Bank.
Got it.
Just some examples which I think Singaporeans are familiar with. I think it's really about the familiarity of home names. Maybe just to reiterate the point, Singapore blue chip companies. So DBS, I'm just looking at some notes I have here. DBS, a prominent issuer in the ETF, NTUC, and Singtel.
Certainly
So
well-known names, and we like
well-known names.
familiarity here
We like
in
familiarity
Singapore,
here.
for sure.
That's
You mentioned duration, but I've got to ask the D question. How much dividends do the bond ETFs pay, Eugene?
Let me go through a calculation. Just to answer the question right on, let's use the ABF Singapore Bond Index Fund as an example.
Okay.
Distribution yield is about 2.4 to 2.5% per annum, which is, in my opinion, relatively high for the quality of bonds that are inside this ETF, right? Once again, this is AAA rated bonds issued by the Singapore government.
Right.
Very rare to see, AAA rated issuers in the world right now, and I think we are very happy and privileged that we are, part of Singapore, which still has maintained that AAA ratings over the course of time. So let's go into the numbers here. ABF Singapore Bond Index Fund. There were two payouts recently in the last year. In July 2024, the most recent one, payout of about 0.0124 cents per unit. And in January 2024, a payout of 0.124 cents per unit. Just based on the last price of about $1.05, right? That gives you the distribution yield of 2.4%. Right. I also alluded that you would be expecting distribution payments on a semi-annual basis. Okay. Distributions are comprised of distributable income,
Mhm.
i.e., whatever distributions, whatever coupon payments that the bonds in this basket distributes out, it gets passed through to you as the end investor of the in the ETF, right? We do take note. These two take note that distributions are not always guaranteed. They are at the discretion of the manager, but Nikko has generally, for as long as I can remember, actually, has always been paying out dividends on a semi-annual basis.
Okay, so the prospect of steady dividends we like. Here comes the double edged question. We'll
Mm.
start first with the advantages of bond ETFs as you see it, Eugene.
I think we touched on that. I think the most attractive advantage of bond ETFs now, as a complement to T-bills, as we started this conversation, is really the potential for capital gain if
Mm.
and when interest rate falls.
Mm-hmm.
That's a crystal ball question. I think the question is when, but is there a growing momentum that interest rates should start to fall as we move into the second half of 2024? I think there is that growing momentum, and therefore bond ETFs offer that greater potential for capital gains. The price of bonds may go up and go down should interest rates, well, inversely related, decline and or increase. So if interest rates start to fall, imagine a seesaw. If interest rates start to fall, then because of the inverse relationship, prices of bonds and or bond ETFs would also be expected to rise. And we have actually seen some of that already happening. If we look at our Nikko Sing dollar denominated investment grade corporate bond,
Mm.
the net asset value of the ETF has been rising since July last year, as we see expectations of interest rates start to decline over the same period. And if you just Google the charts, you would see that as interest rates or expectations of interest rates start to fall in that same period, that bond ETF, the prices have also started to inch up in a gradual and steady manner. I could talk about returns if our listeners are interested. I just want to point this out because I was quite surprised that the Nikko Sing Dollar Investment Grade Corporate Bond ETF actually generated a return of above 6%, so 6.3% over the past year as of end of May this year. Right. So
Wow.
for bond ETF, I thought that was quite interesting. 6.3% returns over the year ending
Mm.
31st May.
It's getting a big nod from me, that. Mm-hmm.
Yeah, yeah, and I think that's a sign of the time. I think and as an asset class, I think it has performed quite well. The next point is okay. So capital gains is good. I get the kicker. I understand there's an upside, but to balance that, I think some people also want resilience, right? So
Yes.
when that's also an important part of looking at your whole portfolio. So I think that's where I think a bond ETF like the ABF Singapore Bond Fund and the index that it tracks has performed well during previous episodes of financial uncertainty. So if we go all the way back to the global financial crisis, the start of COVID, for example, when investors were looking for safe haven assets, I think that's where they turned to the Singapore government bonds as an asset class, right? Really, because it's such high quality, it's triple A, and Singapore is the only Asian country that has this triple A credit rating awarded by all three major credit rating agencies,
Mm-hmm.
and it has maintained that credit rating over the last 25 years. Yeah, and that includes, well, the global financial crisis in 2008 and what my parents went through, the Asian financial crisis of 1997. History of resilience, and I think Singaporeans, we're quite proud that we are a resilient people and country, especially as we are heading into National Day, I think.
Yeah, that's a good point,
Yeah,
Eugene. Okay,
yeah,
so we need to come to the, we want to be balanced as always with our listeners.
yeah.
So we've talked about the advantages of bond ETFs. We've talked about payouts. We've talked about
Mm,
resilience. What are the
mm.
risks of bond ETFs?
So we go back to the seesaw. We are expecting interest rates to come down, but is that a certainty? Do I have a crystal ball that says it's going to happen in a specific timeline? I do not, and I don't think anyone really has. So in that context, that's where the flip side of holding a bond ETF really lies. So therefore, there is greater capital risk compared to, let's say, T-bills, for example, right? Because with the upside, there's also potential for a similar downside. As well, if you compare it to an individual bond, an individual security, when we're looking at a bond ETF, it does not have a maturity date per se. We mentioned that every single bond, you do expect that you get your principal back once the maturity date is met. Whereas for bond ETFs, they don't mature per se. It's, I would say, something like an evergreen asset, right? As such, so there's no guarantee that you'll get back your initial investment. So the price of a bond ETF may go down when interest rates are rising, and it means you have to be aware that you may suffer some capital loss if you were to sell the bond ETF at a particular point of time, i.e., you crystallize that loss.
We're going to wrap up,
Okay.
Eugene. So if you could
Mhm.
share with us final thoughts on the bond ETFs.
Please consider the ABF Singapore Bond Index Fund if you're looking for passive income through a diversified portfolio of Singapore government bonds and some potential capital appreciation should interest rates start to fall. However, if you want something with a slightly higher yield with slightly higher credit risk, but
Mhm.
still within the investment grade spectrum, you can consider investment grade corporate bond ETFs, which you can get access to through the Nikko AM Sing Dollar investment grade corporate bond ETF. If you'd like to find out more, you can always visit our website.
Okay, wonderful. We'll do that. Thank you so much, Eugene Lim, Senior
All
ETF
right.
Business Development Manager, Nikko Asset Management Asia Limited. I'm Michelle Martin, and this has been ETF Insights. Thank you so much, Eugene.
Thank you so much, Michelle.
ETF Insights is brought to you by Nikko Asset Management. Your goals, our commitment. Learn more at nikkoam.com.sg/ETF.
Money FM 89.3.